Welcome back to the channel everyone, Nick Armentis here. In today's video I'm going to cover off why the A2 Milk share price is getting absolutely smashed today. So it's down almost 10%, and if we look back guys, let's look at the max. Since hitting its high around July of 2020, it is down 68%. Now the reason I wanted to cover off is I have mentioned this stock before and thought, probably around about December, I believe, to January. I mentioned that I thought it was relatively priced well, but luckily I didn't buy, and I would be down 37% there. And I mean, reflecting back on my own kind of trading and stock market investing, I do tend to look at beating down stocks too much. And while, I mean, you can't really complain about this stock if you were a long-term holder, I think my temperament seems to be too much active trading, which I definitely have to tone down. So, I mean, you'd be up well over 1,000% on this stock if you'd held from 2015. So, I mean, in 6 years, that's pretty amazing. But then if you bought here, you're down 68%. So why has this happened? If we look at a bit of a shorter time frame, so like a year, the COVID run up. So let's have a look here. So, we had COVID occur in March of 2020. And because there was a stockpiling, the stock popped like 20-odd%, right? Since then, it's had multiple downgrades. You can kind of see them here. There's actually 4. So there was one that happened back here, 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 and here. So this is the 4th time that they've, I guess, readjusted guidance and earnings. And so, I mean, who knows, but you'd have to expect that eventually this bad news is going to flow out. I mean, the major reason has been the Daigou channel, which is, people buying A2 Milk here and then taking it back to channel and then taking it back to China. Obviously, because of COVID, that's completely gone, right? Obviously, competition and a whole range of other things as well. But let's dive into the 2 announcements that were made today and work out what's going on with this stock. So the first is that Peter Nathan, who was the Chief Executive Officer of Asia Pacific, he has resigned, and he actually sold about $15 million worth of stock just before these series of downgrades occur. So in August, him and a few insiders sold quite a bit of stock. I mean, for them, obviously, it was quite good. For the for the investors, obviously not so much. And you'd imagine that a lot of people are feeling pretty bad about that because he did that almost at the perfect time. And now, while that might just be coincidence, you'd assume that it would be safe to assume that, obviously something was going on already, and potentially people insiders started to go, you know what, this is starting to look a little bit precarious, I'm out. And potentially they thought that, just like me, I thought that COVID was going to last a lot shorter time frame than it did. And that it has, and so the stock has been hit hard, earnings have been hit hard. So I thought the exact same thing. I'm assuming the A2 Milk team thought as much, and obviously this didn't occur. So the first one is, someone has resigned. He's been there for a very long time, 14 years. So, you'd assume that he's got quite a bit of knowledge. So whether he's been pushed out or what it is, I'm not too sure. So, probably have a read through it and come to your own conclusion. He's going to be there for a little while, as it says here, but he's been there from pretty much day dot. And yeah, that's obviously potentially a blow to the business, but I think what they're probably wanting to do is bring in some new blood, some fresh eyes, because this trading update wasn't great. So here are the key points. The trading dynamics in China infant nutrition market have been and continue to be challenging for A2 Milk and many international competitors. While the third quarter trading was broadly in line with the plan, it's clear that the actions taken to address the challenges in the Daigou reseller and CBEC channels will not result in sufficient improvement on Q3 2021 in pricing, sales and inventory levels to meet our previous guidance based on April sales being well below plan. So guys, just as a note, it's pretty common for businesses that are doing well to get ahead of themselves and forecast that this growth is going to occur forever. And obviously it hasn't continued, and obviously COVID was a big part of that, but they've not forecasted this correct. So obviously a big forecast miss on them. The board tasked management to undertake a comprehensive review of inventory in the trade, and this work has indicated that the level of channel inventory is higher than had been anticipated. The problem with having higher inventory, guys, is margin comes under pressure as you sell more, and prices of what you're selling at, the average price goes down, so you make less money. So this isn't a good sign. And personally, if I was in the stock, and obviously not financial advice, I'm not a financial professional, I'd probably be exiting out of this. There's no end in sight yet. Long-term shareholders, if you're still up, the 1,000%, then it probably doesn't matter. But if you've been in there recent, I don't see any reason at the moment to stay in this at the moment. It's just these pressures aren't going to change overnight. Now, whether or not the stock is fairly valued, I don't know. It's still a good business, but to be honest, guys, me personally, I would be out based on this announcement. So in the interest of long-term health of the A2 brand and the medium-term trading outlook of the business, more aggressive actions to address excess inventory will be taken, which will impact FY21 revenue, EBITDA, and potentially first quarter of 2022. So obviously quite some time that you're going to be waiting around for something to change in this business. Is it a beaten down value name? Who knows? The inventory management actions will be being taken will provide Chinese mothers with the freshest infant milk formula and benefit the company's customers, distributors, and partners. Okay, that's a nothing comment. They're going to increase marketing spend to drive consumer demand, obviously, so then EBIT margins and EBIT will go down because they're spending more on marketing. Despite these short-term setbacks, the company remains confident in the long-term opportunity, and I agree with that. So long-term opportunity is still there, and is determined to build a strong position. So, if you're going to buy and hold for 5 years, probably a good entry point around here. I'd wait for the price to stabilize over the next few weeks. But yeah, I mean, as a short-term thing, if you're looking in the next 12 months, this isn't going anywhere until travel opens up and things like that. However, the company recognized that the China market and channel structure is changing rapidly and has therefore commenced a comprehensive process to review its growth strategy and executional plans to respond to this new environment. So, one, this is going to take time. Two, even those actions may not do anything, right? It could just be that this is going to take time to work itself out with borders opening up and things like that. In addition, the board is actively considering capital management initiatives, including a potential share buyback, and an update will be provided at full year results in August. So, I mean, a share buyback now probably isn't a bad time given the stock has been down. Again, I'd have to look at the details of that to determine whether or not it's a good idea. As noted throughout the past year, there continues to be an unprecedented levels of uncertainty and volatility due to COVID-19. So some people have benefited, these guys did not. So they're saying that competitors have been impacted. So it's not something unique to A2. In February, they've outlined that they're taking actions. Obviously it didn't help, and it's in the Daigou reseller and the cross-border e-commerce channels. The company indicated that to activate this, it was aimed to rebalance inventory levels. Okay, fair enough. So the trading update, while third quarter group sales are broadly in line with the revised plan of 295 million. It's emerging that actions to address the challenges have not resulted in sufficient improvement in pricing, sales, and inventory. So they're basically telling people while the quarter was okay and in line with what they thought, April was not good, and it looks like things are going to get tougher for them. So they've got a 11% and 57% decline in these two channels, and a 56 and 77%. So it's gotten way worse in the third quarter. Which they reckon was in line, but still obviously not good. The business is going backwards. They're down due to actions to reduce distributor inventory levels, which means they're basically marking down inventory and selling it at a lower price. And because they've got more inventory and they didn't have good enough visibility of where stock was, how much they had, they've probably created too much and created an oversupply of it. 5% growth on third quarter and 18% decline on the prior quarter. Obviously not great either. Store counts up, but I guess it doesn't really matter. All these other bits and pieces, US is doing well. It's just not big enough. They need China to fire, and if it doesn't, they're not going to do well. So they're saying that they've got very hard challenges with visibility into third-party inventory levels. The data is not complete. The review has indicated the level of channel inventory is higher than had been anticipated. So again, they've already done some markdowns. They're going to be doing it more. And they're going to be giving margin support, which means they're going to be giving better prices or rebates to companies selling their products. From a consumer perspective, they're going to get better pricing. So potentially longer term, they get more market share because they've lowered their pricing. Longer term, their margins are going down. So the profitability and how you, would value this business it's not as favorable. Rebalancing inventory by further reducing Selling to Daigou will need to continue for the rest of the quarter. Again, so they're telling us it's going to continue. And they're going to have to take a stock provision on the books of 80 to 90 million in addition to the 23 million. So now they're starting to get into write-downs as well. Not great. But okay, what's the updated outlook? The more aggressive actions will impact FY21 results. The board believes it's imperative to take these necessary actions to address the imbalances and return to growth in the future, basically. It's also critical the company continues to invest in the brand. Okay, fair enough. And the plan to further increase levels of marketing in the fourth quarter FY21 and FY22. Consequently, a high level of marketing investment. So telling us they're going to spend more on marketing. It be increased, particularly in digital marketing, to help drive consumer demand. So potentially they need a new marketing person, a marketing-based CEO, someone that's going to take them through this period and into the other side, or potentially they need someone totally different, someone that's good at navigating such times. So then they give us their revenue guidance of 1.2 to 1.25 billion, which is a significant decline, obviously not great, and it's going to take some time to rebalance. An immediate recovery is not expected, and a further update for FY22 will be provided in August. So between now and August, this is probably going to be on a slippery slope downwards unless we see something else happen, right? Which is unlikely. So August is the time when we're going to find out what's going on. And then they give us a bit of guidance onto EBITDA, and again, it's not great. And they're telling us, about the cash flow as well. So this year they made investment into a capital raising with Synlait. And bought a milk processing facility. So they're just outlining their costs, and obviously there's nothing really that good in here, guys. It's important to recognise that the revised outlook does not reflect the underlying performance of the business. It's still a good business, admittedly, but from a stock point of view, you just don't see this recovering anytime soon based on this. It's been the fourth time. So unless you're looking at this in the long term, guys, based on what I'm reading here, and the rest of it, have a look through it. There's been leadership changes, etc. It's a short-term setback likely in the scheme of things, but if you're wanting quick money, which most people on YouTube are, or even, if you're not willing to see this drop another 20 or 30%, which it very well could get back to, $4, $5 quite easily, then probably just stay away from this one. But guys, please smash the like button, subscribe, and let me know your thoughts on A2 Milk.